Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we focus on Nigeria's 2025 tax revolution, what it means for you. On June 26, 2025, President Bola Ahmed Tinubu signed 4 transformative tax bills into law, representing a significant overhaul of Nigeria's tax system. These reforms aim to 1. Simplify tax compliance and administration, 2. Increase non-oil revenue and lessen fiscal reliance on oil, 3. Improve economic competitiveness and attract investment, 4. Offer relief to low-income earners and small businesses, 5. Align Nigeria's tax system with international standards. The 4 acts are 1. Nigeria Tax Act, NTA 2025. This act consolidates major tax laws and repeals outdated ones such as Company Income Tax Act, Personal Income Tax Act, Capital Gains Tax Act, and Value Added Tax Act. 2. Nigeria Tax Administration Act, NTAA 2025. This act streamlines the processes for tax collection and compliance. 3. Nigeria Revenue Service Establishment Act, NRSA 2025. This act replaces the Federal Inland Revenue Services FIRS with the Nigeria Revenue Services NRS to enhance efficiency. 4. Joint Revenue Board Establishment Act, GRBA. This act establishes a coordinating body for federal, state, and local tax authorities and introduces a tax ombudsman and a tax appeal tribunal. Expected to take effect from January 1st, 2026, these laws introduce a digital-first, streamlined, and taxpayer-conscious tax system. We highlight some of the key provisions. 1. Small business relief. Companies with annual revenue less than or equal to 100 million and fixed assets of less than or equal to 250 million naira are exempt from corporate income tax, CIT, capital gain tax, CGT, and new development levy. 2. Corporate tax cuts. CIT reduced for large companies from 30% to 27.5% in 2025, then phased to 25% in 2026. Medium-sized companies, 100 million to 1 billion naira, are expected to pay around 20%. 3. Development levy. A 4% levy on accessible profits replaces multiple levies like tertiary education and police. 4. Minimum effective tax rate, ETR. Multinationals turnover higher or equals to 50 billion naira or parent higher or equals to 750 million euros must pay a 15% ETR aligning with the OECD standards. 5. Capital gains tax, CGT. The corporate CGT rate rises from 10% to 30%. Individuals are taxed according to their income band, which matches their personal income tax, PIT. This ranges from 0% from income up to 800,000 naira, 7.5% to 15% for middle income earners, which is 800,000 naira to 5 million naira, and up to 25% for those earning above 5 million naira annually. Indirect share transfers are now taxable. Small share sales, less than or equal to 150 million, gains less than or equal to 10 million naira are exempt. Gains from digital and crypto assets are now taxed. 6. VAT changes. The rate remains at 7.5%, but certain basics including food, healthcare, education, rent, power, and certain exports are 0 rated. Input VAT recovery broadened. Mandatory e-invoicing and digital fiscalization introduced. 7. Personnel income tax reform. Progressive bracket with 0% up to 800,000 naira exempt, rising to 25% for higher incomes. Exemption for employment and injury compensation increased to 50 million naira. 8. Tax administration overhaul. Establishes a unified Nigeria Revenue Services NRS, phases out multiple federal tax collectors, creates joint boards, and establishes a tax ombudsman. 9. VAT revenue sharing formula revised. Federal government share reduced from 15% to 10%. State governments increased to 55% and local governments increased to 35%. 10. Stricter penalties for tax non-compliance. Failure to file returns results in a penalty of 100,000 in the first month, with an additional 50,000 naira for each subsequent month the default continues. Contract compliance. 5 million naira fine for awarding contracts to entities not registered for tax. What are the implications? For businesses, 1. Small and informal businesses benefit from tax relief and simpler compliance, which likely boosts formalization. 2. The corporate sector benefits from lower tax rates and VAT recoveries, although the development levy and effective tax rate provisions increase liabilities, especially for multinationals. 3. Multinationals must align with global ETR rules and may pay additional top-up taxes if the effective tax falls under 15%. 4. Oil and gas, renewables, and agriculture enjoy targeted incentives, though new levies still apply. 5. Free zone tax benefits are limited to exports only. 6. ERP and process changes. Businesses must update accounting systems for EVAT, fiscalization, new return formats, and revised VAT recovery rules. For the economy and government, 1. Revenue projection. Aiming to increase the tax to GDP ratio from approximately 10% to 18% by 2026, thus reducing borrowing and funding, infrastructure, health, and education. 2. Administrative efficiency. A unified Nigeria revenue services with digital tools could minimize corruption and leakages while boosting compliance. 3. VAT revenue sharing formula revised. This change will promote greater accountability and service delivery, ease of doing business at the state and local level. For individuals, 1. Low-income earners earning less than or equal to 800,000 naira per year are fully exempt. 0 rating and impute VAT savings are applied to essentials, and rent relief helps homeowners. 2. Higher earners face steep personal income tax and capital gain tax, mitigating inequality. For investors, 1. Global investors should welcome the move, a clearer, harmonized tax code, incentive clarity, and alignment with OECD models, which will raise investor confidence and Nigeria's credit profile. 2. Regional fairness issue. Consumption-based VAT revenue sharing, 30% allotted by consumption, rest among states, could benefit consumption-heavy southern regions, raising equity concerns. 3. Clear exit tax and restructuring provisions provide predictability for divestments and asset planning. 4. Greater legal certainty with a unified law and streamlined dispute processes. The 2025 tax reform laws represent significant change in Nigeria's fiscal landscape. Designed to promote equity, enhance digital compliance, and boost economic competitiveness, these laws aim to reduce revenue leakages, support small businesses, and simplify tax administration. Successful implementation of these reforms depend on the following factors: stakeholder sensitization, institutional readiness, technology development, and clear transitional guidelines prior to the January 2026 launch. Call to action. Every taxpayer, whether an individual or corporation, must review their tax position, update their systems, and prepare for a new era of accountability and digital enforcement. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week.